In the world of investing, risk and reward go hand in hand. But how do you measure it? Enter the Sharpe Ratio. When it comes to investing, understanding risk is crucial. Whether you're a seasoned Wall Street wolf or a newcomer dipping your toes in the waters of cryptocurrency, the potential for profit always comes with a degree of risk. The question is, how can you quantify that risk? More importantly, how can you determine if the potential rewards are worth the risk you're taking? That's where the Sharpe Ratio comes into play. It's a tool that allows investors to measure risk-adjusted returns. The Sharpe Ratio is essentially a way to express the return on an investment in relation to the risk associated with that investment. It's like a compass guiding you through the rocky terrain of investment decisions. So, the Sharpe Ratio helps us understand the return we are getting for the risk we are taking. But how does it work? At its core, the Sharpe Ratio is a simple mathematical formula. It's a tool used by investors to understand the return of an investment compared to its risk. It's named after Nobel laureate William F. Sharpe, and it's been a staple in financial analysis since the 1960s. So how does it work? The Sharpe Ratio is calculated by taking the difference between the returns of the investment and the risk-free rate of return, and then dividing that by the standard deviation of the investment's returns. Let's break that down. The returns of the investment are, quite simply, the gains you're expecting from your investment. This could be the dividends from a stock, the interest from a bond, or the appreciation in value of a cryptocurrency. The risk-free rate of return is a theoretical concept in finance. It's the return you could expect from an investment with zero risk. Typically, this is represented by the yield on a government bond. The standard deviation is a measure of how much the returns on an investment vary. It gives us an idea of the volatility of the investment. A higher standard deviation means the returns are more spread out, which generally indicates a riskier investment. So, when you subtract the risk-free rate of return from the expected returns, you're essentially figuring out the excess return of the investment. This is the return you're getting for taking on some risk. Then, when you divide this excess return by the standard deviation, you're adjusting this return for the amount of risk involved. The result is the Sharpe Ratio. If you have a higher Sharpe Ratio, it means you're getting more return for each unit of risk you're taking on. It's like getting more bang for your buck. And why is this important? Well, as an investor, you want to maximize your returns while minimizing your risk. The Sharpe Ratio helps you do just that. So, a higher Sharpe Ratio means better risk-adjusted returns. But what does this mean in the context of stocks and cryptocurrency portfolios? That's what we'll explore in the next scene. Stay tuned. When comparing different types of investments, the Sharpe Ratio levels the playing field. It's like a referee in a boxing match between stocks and cryptocurrencies. The Sharpe Ratio allows us to compare these two contenders in terms of risk-adjusted returns, giving us a clearer picture of which could potentially pack a more rewarding punch for our portfolios. Let's start with stocks. They've been around for centuries, providing a means for individuals to own a piece of a company and share in its profits. These investments have historically offered steady, albeit slower, growth. When we calculate the Sharpe Ratio for a diversified stock portfolio, we typically find a moderate figure. This reflects the relatively lower risk associated with stocks, balanced with reliable returns. Now let's shift our attention to the new kid on the block: cryptocurrency. Cryptos are digital or virtual currencies that use cryptography for security. They've exploded onto the investment scene in recent years, with their value often swinging wildly from one day to the next. This high volatility significantly impacts the Sharpe Ratio of a crypto portfolio. When the crypto market is booming, the Sharpe Ratio can skyrocket, reflecting the potentially high returns. However, during a market downturn, the ratio can plummet, indicating a high level of risk. It's important to note that while the Sharpe Ratio can help us compare different investment types, it doesn't tell the whole story. For instance, it doesn't consider the potential impact of a major market shift or the introduction of new regulations. It also doesn't factor in the personal risk tolerance of an investor. So while cryptocurrency can offer higher potential returns, it also comes with higher risk. But remember, the Sharpe Ratio is just one tool in your investment toolbox. It's essential to consider other factors and conduct thorough research before making any investment decisions. After all, in the world of investing, knowledge truly is power. Like any tool, the Sharpe Ratio has its limitations. It's essential to remember that the Sharpe Ratio relies heavily on historical data. This means it's looking in the rearview mirror telling you how an investment has performed in the past, but it can't predict the future. Just because a portfolio has had high risk-adjusted returns historically, doesn't guarantee that this will continue. Another limitation is the assumption that investment returns are normally distributed. This bell curve assumption works well for many scenarios, but it may not hold true for all investments, especially in the volatile world of cryptocurrencies. Extreme price movements, known as fat tails, occur more frequently in crypto markets than in traditional ones, and these can distort the Sharpe ratio. Furthermore, the Sharpe ratio only measures the risk of price volatility, ignoring other risks like liquidity risk, credit risk, or regulatory risk, which can be significant, especially in crypto markets. Despite these limitations, the Sharpe ratio remains a valuable tool for comparing risk-adjusted returns. So what's the bottom line when it comes to the Sharpe ratio? Well, let's wrap it up. The Sharpe ratio, in essence, is a tool for measuring risk-adjusted returns. This means it takes into account not just how much you could potentially make from an investment, but also how much risk you're taking on. It's like a balance scale weighing potential reward against potential risk. This ratio can be used to compare different types of investments, from traditional stocks to more volatile cryptocurrency portfolios. It gives us a standardized way to evaluate and contrast these different investment avenues, helping us make more informed decisions. However, it's important to remember that the Sharpe ratio, like any tool, has its limitations. It's not infallible, and it doesn't tell the whole story. But it remains a valuable part of the investor's toolkit, a compass guiding us through the often turbulent seas of investing. Thanks for watching. Remember to like, comment, and subscribe, and don't forget to hit the bell notification so you'll get updates anytime we upload a new video.